Good morning everyone and welcome to Morning Markets here at True Potential on Wednesday the 22nd of March. Today we're going to update you on recent market performance and also cover in a bit of detail the latest inflation print for the UK for the month of February. So as you'll see on screen, yesterday was a much stronger day for equity markets. Equity markets much more comfortable with the intervention from the Swiss authorities with regards to Credit Suisse, and also that the actions by the US Federal Reserve the week prior have resolved some of the near and acute problems within the US regional banking system. It's allowed broader equities to recover somewhat, and also you'll see on screen that bond yields have risen a little. That is, that with this peak in the crisis behind us, markets become more nuanced with regards to the actions from central banks this week. Now this takes us, of course, to the UK inflation print for the month of February, which was released this morning. And the difficulty for the Bank of England is that price pressures in the UK have accelerated again. And it's not just driven by headline inflation prints as it was last year, it's underlying inflation now which is persisting, the so-called services basket, very broad-based inflation across food buckets and recreation, such as going to restaurants and other activities. In fact, food inflation in the UK has now risen to over 18% on the year. And more worryingly for the Bank of England will be that the more timely measures, such as the month-on-month prints, are still very high at around about 2%. So if we were to annualise that number, it would imply that food inflation in the UK could rise to above 20% year on year towards the end of the year. However, these price pressures now largely reflect price pressures from last year in things like grain prices and also fertiliser prices. The main disruption from the Russian invasion of Ukraine still permeates through the inflation basket. However, it's a challenge to try and alleviate these services price pressures because they tend to be more sticky than the headline pressures we became used to last year. So it does matter because we're likely to see higher interest rates beginning tomorrow from the Bank of England. They're likely to increase the policy rate by 25 basis points to 4.25%. This isn't going to be a surprise to markets. Markets have largely priced that in, and although there has been some volatility over the last week or two because of the issues with banks, markets also expect another interest rate hike beyond tomorrow in the UK in the spring, and that would perhaps take the policy rate to around about 4.5%. But by that point, we should see material base effects take hold in the inflation basket, such that headline inflation will fall materially through the spring and into the summer. However, the bank are going to remain vigilant on these sticky services price inflation, so we shouldn't get too overconfident about any interest rate cuts this year so far. So we can conclude that tomorrow the Bank of England will likely maintain their message that the UK economy continues to run a little hot in terms of services price pressures. We will see an interest rate hike. And also please join us tomorrow where colleagues will update you on what messages come from the Federal Reserve in their meeting this evening. Thank you.